Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on the implications of the CBN's MPC's interest rate hike. The Central Bank of Nigeria, CBN's Monetary Policy Committee, had its third meeting of the year last week, Monday and Tuesday, 23rd and 24th May 2022, respectively, to discuss recent global and domestic developments. The MPC is the highest policy-making committee of the CBN and is composed of an 11-man committee, including the CBN governor. The MPC meeting holds bi-monthly, with 3 more meetings to come this year. Surprisingly, the MPC voted unanimously to raise the monetary policy rate for the first time in more than 2 years, while keeping all other policy parameters constant. 4 members voted to increase the MPR by 1%, 1 member voted for a 0.5% increase, and 6 members voted to raise the MPR by 1.5%. Overall, the monetary policy rate was raised by 1.5% to 13%. Asymmetric corridors were retained at plus 100 basis points and minus 700 basis points around the MPR, while the cash reserve ratio, CRR, at 27.5% and liquidity ratio, LR, at 30% were retained. The MPR is the interest rate at which the CBN lends to the commercial banks. The MPR is the benchmark against which other lending rates in the economy are pegged. It is also used as an instrument to control inflation in the economy. Though the MPR has been ineffective in recent years, the rate has been used to signal CBN's intention. To know more about other MPC key rates, kindly listen to our previous podcast on this topic, link inserted. The major considerations that determine the MPC's decisions on key policy rates are discussed below. 1. Inflation rate. The MPC acknowledged rising global inflationary pressures fueled by strong aggregate demand and wage growth that had prompted major central banks like the US Fed to tighten their policy stance in an attempt to rein in inflation, which remained at a 40-year high of 8.3% in April 2022. The committee also noted that supply chain disruptions caused by the Russia-Ukraine crisis and a resurgence of COVID-19 infections in China, the US, and South Africa will continue to put upward pressure on inflation. It is worth pointing out that higher interest rate tends to slow economic growth as consumers tend to spend less and save more. 2. GDP growth. The MPC took note of Nigeria's impressive economic performance in the first quarter of 2022 as GDP grew for the 6th consecutive quarter by 3.11% year-on-year. Growth was majorly driven by improved activities in the non-oil sector, especially in the agricultural and services sector, which grew by 3.16% and 7.45% year-on-year, respectively. The oil sector continued to underperform, contracting for the 10th quarter in a row and by 26.04% year-on-year in Q1 2022 due to weak oil production. What are the implications of the rate hike? 1. Higher borrowing cost. The decision to tighten the MPR immediately fuels a jump in the rate the CBN loans money to banks through the standard lending facility. Due to the fact that the MPR influences all other rates, including the interest rate on loans, it will result in higher borrowing cost for smaller businesses and households, potentially causing a slowdown in economic growth. This will affect existing loans without a fixed rate agreement clause, as most banking loans are floating or variable rates based. This means that the loan rate can be revised upwards or downwards during the lifetime of the loan. 2. Businesses would struggle. Given the increased cost of lending to small businesses, a rate hike should stir up an increase in finance costs, thereby shrinking the business profitability margins. Businesses are also unlikely to refinance existing debts, which could slow investments in their operations. Businesses with inelastic demand for their products will pass the increased costs directly to the consumers, leading to lower purchasing power. 3. Higher interest income for banks. Banks are expected to reap the benefit of a higher rate as interest income which is the major revenue driver for banks, would be boosted by the increased yield on fixed income instruments and higher interest rate on loans. This will cover up for the expected drop in income from fixed income securities due to the resumption of taxes on some fixed income instruments by the federal government. Listed banking stocks will benefit positively from this. 4. Mixed impact on inflation. Although a rate hike generally tames inflationary pressures by slowing down consumer spending, it is pertinent to note that inflation in Nigeria is mainly driven by supply constraints rather than increasing aggregate demand. So a rate hike might not be sufficient to bring down inflation. The pass-through effect of higher production costs will lead to higher prices and higher inflation rates. 5. Weaker investor interest in equities. With the market having returned over 26% so far in the year, the recent rate hike will dampen investors' interest in the equities market as fixed income instruments become more attractive. We expect to see a gradual rotation out of the stock market and into the fixed income space, thereby triggering the much awaited correction in the market. While we advise you to maintain caution when buying stocks, you can consider positioning for undervalued stocks with attractive dividend yields. 6. Higher fixed income rates. We expect yields to rise as a result of the rate hike and government's increased borrowing plan, making fixed income instruments more appealing. In the same way, this should reduce the negative real rate of return and boost domestic participation. Following the CBN's decision to raise the rate, the Treasury Bills primary market auction, which held a day after the MPR was raised, saw a 1.79 percentage point jump in rate on the 364-day bills. However, this will result in fewer commercial paper issuances by corporates as investors will demand a greater premium. The next MPC meeting will hold on the 26th and 27th of July, where we believe the MPC will adopt a wait-and-see approach to see the impact of its latest decision. In our view, we do not expect inflationary pressures to abate given the underlying structural issues and continuous low base effect. Thank you for listening. Please join us same time next week for another interesting and exciting session. For questions, comments, and feedback, kindly forward to info@getfinanceandinvestmenttips.com or send SMS to 070-8246-3747. Stay blessed.